In today's video, we're going to demystify the process of paying yourself as the owner of a business. We'll be covering 3 common business structures: sole proprietorship, partnership, and S-corp, and also shedding light on the tax implications and self-employment tax. So let's dive in. Let's begin with the most straightforward business structure, the sole proprietorship. As the sole owner of this type of business, you have the freedom to pay yourself from the profits generated. Since the business and yourself are considered one entity, you don't have to go through any formalities or paperwork to pay yourself. You can simply withdraw funds from the business account for personal use as needed. However, it's crucial to keep in mind that as a sole proprietor, you're personally responsible for all the business's debts and liabilities. On the tax front, the income you withdraw from the business is subject to self-employment tax. Self-employment tax encompasses both the employer and employee portions of Social Security and Medicare taxes. This tax is usually calculated based on your net profit, and you'll report it on your personal income tax return using Schedule SE. Now, let's move on to partnerships. In a partnership, where 2 or more individuals share ownership and responsibilities, paying yourself requires a slightly different approach. Instead of directly paying yourself from the profits, you and your partners will typically distribute the profits based on the agreed-upon partnership agreement. It's essential to create a partnership agreement that outlines how profits are distributed among partners. This agreement can be based on various factors, such as percentage of ownership or predetermined salary. The share of profits you receive will be subject to self-employment tax, similar to a sole proprietorship. Finally, let's explore paying yourself in an S-corporation, also known as an S-corp. In an S-corp, the business is considered a separate legal entity from its owners. As an owner of an S-corp, you become an employee of the business. This means that you will pay yourself a regular salary as any other employee, subject to payroll taxes, including Social Security and Medicare taxes. Any remaining profits beyond your salary can be distributed to the owners as dividends. The important thing to note here is that dividends are not subject to self-employment tax. However, it's crucial to ensure that the salary you pay yourself is reasonable and in line with industry standards to avoid any potential issues with the IRS. And there you have it. We've covered the basics of paying yourself as the owner of a sole proprietorship, partnership, and an S-corp. Each business structure has its unique considerations and tax implications. Remember to consult with a tax professional or accountant to ensure you're following the correct procedures and maximizing your tax advantages. Thanks for watching, and stay tuned for more valuable insights.